I have some clients here, Johnny and Jenny YouTube. Well, I'm actually protecting their names. But they got $2 million and they want to retire with the same lifestyle they have right now. Initially, I think it's okay. But they want to retire right now and they want to make their money last. So I thought it'd be cool to go through all the details on what a $2 million net worth looks like throughout retirement. And I'm going to take you along the journey with me. If you haven't already, please make sure to like and subscribe so you're going to get more videos like this as they come. I'm going to build more plans and I'm going to share them with you, help you navigate retirement and make the necessary adjustments so you can live the retirement you want. So as you can see here, I got Johnny and Jenny YouTube. In investments, broken up between taxable assets and an old 401k, they have $1.7 million, which is really, really good. And you notice here, I have YouTube Cash. It's Johnny and Jenny YouTube, so YouTube's their last name. But they have a lot of money in cash. They've been very, very good savers throughout their earning years. So they've accumulated a big bundle of cash just earning like 1% or 2%. So we're going to address that. But you can see then they have additional investments of about $475,000 and then a 401k account worth about $750,000. They also have their primary home that is paid for. I put their taxes and insurance already in here so the cash flows account for that as an expense. You can see Johnny and Jenny, their habits and their behaviors have been phenomenal. They've really been able to accumulate a lot of money, work together to build this retirement. And as we move into the goals of them retiring right now at their current age of age 62, which they were basically ready to retire, they could have done it on their own. They just weren't sure. They felt the seriousness of this process. They want to make their money last. They want to do it the right way. So they came to me to double check their work. They want $4,000 a month in retirement expenses. That's just their living expense. That doesn't include any potential taxes, and it doesn't include any other expenses that I enter in like taxes or insurance for their property. But remember, they don't have a mortgage. I've already entered in some healthcare costs and some out-of-pocket long-term care expenses towards the end of life. As you can see, they don't have any income. They're essentially retired, but they are going to have Social Security. Johnny's going to get about $3,000 at his full retirement age of 67. And then Jenny, her benefit is about $1,000, but because she's a spouse of Johnny, Jenny will be able to take the spousal benefit, which will be 50% of his. Their current pre-retirement living expenses are $4,000, so they want to transfer to retirement with the exact same lifestyle they have now. So now what we do is we run it through the simulation, we find the probability of success. How does retiring right now with no earned income, being able to need to bridge our income for 5 years from our own assets till Social Security kicks in, and then make that money last for the remainder of retirement look? Well, I'm going to tell you next. It looks really, really good. It's a high probability of success at 88%, and anything above 80 is very good. But don't look at probability of success as probability of success. It is basically, look at it this way. 12% of the scenarios that the system ran in the Monte Carlo simulation were scenarios where I had to come back to Johnny and Jenny and say, hey, you got to spend a little bit less, just a tiny bit less. And I'm going to show you what that process would look like here in just a couple minutes. So stay with me, but I got to give you some more details. One detail that's really important is their investment breakdown is basically 50% equities and 50% fixed income, including a ton or 30% of cash. They have a very low allocation, a good portion of cash, where the annual return with that build out is about 5% a year historically, which is fine. That's nothing to balk at, but you're only getting a couple percent above inflation, which that $4,000 a month or $48,000 a year of spending money is inflation adjusted every single year. So each year it's going to become more expensive to live in retirement. So the investments are like the fuel of this. And I can simulate, what if we increased your allocation just to maybe a 60-40, got rid of some of the cash because you don't really need it. And what if we increase your allocation? That increased your probability of success substantially, but then you're going to say, well, they just end up with more assets at the end of life, which is true. So now we could essentially adjust. What if we took your retirement expenses to an additional $12,000 a year? That's another really big, nice vacation. Spend a little bit of it. That brings our probability back into a very safe level above 80%. So changing the investment allocation just slightly helps the plan function and you spend actually even more. What's cool about this is I can track this in the cash flows. Look right here, you can see 63, 64, 65, 66, and 67. These 5 years, they do not have any income. They're retired. And their expenses are such, 77, 80, 83, 86, 89, which their expenses are their living expense, that $5,000 I took their $4,000 to $5,000 to. So I did something awesome as a retirement planner. I said, hey, if we make a minor adjustment, help me navigate this, you can spend a little bit more. And it's not a major adjustment. It's a minor adjustment, but it's very important. Then we got your housing and healthcare costs all built in there. So they need more than just their living expenses. It creates a very small tax bill. And so their total outflows are $77,000. You can see here in these next 5 years, they have big outflows because they're funding these 5 years on their own. But then at 68, when they turn essentially 67, 68, they start getting Social Security, a full year of Social Security. Their flows from their retirement accounts are very minimal here in 2030. And now they're starting to supplement very little to meet their total annual expense need, which gets bigger every single year because of inflation. Now let's stop right there. I know some of you are gonna say, well, that's not how it works. You actually start to spend a little bit less as you get older. Absolutely. But what I'm trying to do is I'm trying to simulate the most income damaging scenarios. What if you wanted to spend this maximum amount throughout retirement? You could. But if there's the years where you spend less, it would be even better. So I think we should take a little detour into one way that I help actually implement income distribution strategies in retirement. So I use a very specific model, guardrails, helping clients navigate retirement when they have invested assets. You can see here the current balance in the blue is 1.7 million. Their retirement paycheck, like I mentioned, is about $5,620 per month. That's gross. So we're really matched up on this extra income specific software that I utilize to help actually tell clients how much they can spend, almost down to the dollar. But what's cool about this is if the balance of the portfolio actually outperforms in a year, they could get a bump in income. They could actually spend a little bit more. But remember I told you those maybe 10 to 15% of scenarios where I say, hey, you got to spend a little bit less? Look if the balance of your portfolio in the red here actually dropped by a substantial percentage. I'd actually have to come to you and say, hey, you got to spend a little bit less. But you can look, it's only $300 a month. More specifically, these are the upper and lower guardrails. So from 1.75, if you go up over 19% in a year, you get a little bonus. If it actually drops further than 38%, you're going to get a little bit of a pay cut. But the lower guardrail doesn't happen very often. You're going to stay within these guardrails the majority of retirement, which means you're going to get your income plus an inflation adjusted. But this is a more deliberate way to navigate your spending so you actually spend more of your money in retirement and still have success. This is a different layer that most advisors won't go into with their clients because they don't know how to actually navigate a distribution strategy. The last thing I want to show you was the withdrawal rate. So of the $1.725 million, that's the money that we're going to be using for income. So in the beginning of this video, I said $2.2 million net worth. The house can't be used. That just helps reduce down your expenses, which really helps the assets grow because that's less that you need to withdraw. But the house can't be used for income, so I can only focus on the $1.725 million as the fuel that we're going to distribute assets from. So in the beginning, our withdrawal rates are 4.2, 4.26, 4.32, 4.38, 4.4, and then it drops off at 68. Remember, that's when Social Security kicks in. And then at 75, it bumps back up. And you say, well, why does this spending almost double overnight? And the reason for that is because of required minimum distributions. Remember, they have that 401k that's got a good chunk of money in it. That's going to continue to grow in the background until the IRS says they want a portion of that. There's no more deferral. And you need to make distributions, pay the taxes. So at 75 for both these clients, the tax bill is going to go up and the distribution is going to go up. So you're going to get a lot more income almost overnight just from required minimum distributions. This is a big tax element that we need to prepare for. Maybe not avoidable completely. You could potentially do Roth conversions, but I don't know if they'd make sense in this particular case. But you're going to get at age 75, you can see here, income from Social Security, RMDs from the IRAs. So you're going to get more money than you actually need. And you'll notice you actually have a surplus of about $5,000 a year. And I shouldn't say you, Johnny and Jenny will. So it's a really interesting dynamic on how to navigate income in retirement from a $2 million portfolio. It's absolutely possible to do this safely and securely through retirement. So let's quickly review. With a better investment strategy, you'll be able to spend more money safely. And with a great income distribution strategy, you'll potentially be able to spend even more based on the market scenarios that happen on a volatile basis. And then the house isn't a way to distribute income, but it helps reduce down the expenses needed to survive in retirement with a paid off house. But these particular individuals are in a very good spot. I'm gonna help navigate a lot of this. We also worked on estate planning, insurance. We talked about long-term care, Medicare, and we're making sure to navigate Social Security. If you're looking for these same types of elements in your retirement or your future, please reach out, propathfinancial.com. I can't wait to hear from you. Thanks for watching.